What's going on, guys? D. Anthony here with Evolution Traders. In this video, I want to show you guys how you can scalp the NASDAQ futures, the ES futures, CL, gold. It really doesn't matter what asset that you're trading, but using the 2-minute time frame, the 200 period moving average, which is the 200 SMA, and the 20 period moving average, 20 SMA. So with that being said, the reason why we're going to kind of look into why potentially you might want to trade the 2-minute versus what I talk a lot about, the 5-minute, is a couple of reasons. If you find yourself getting chopped up, if you find yourself trading potential setups that have too much range, meaning the stop loss is too big, if you do take that loss, it's normally a lot bigger of a loss than you want to take. It's because the time frame that you're trading is going to have more data, more price action in it, which is going to create a bigger range, essentially creating a larger stop loss, resulting in bigger dollar amounts lost. So with that said, if we look at the 2-minute time frame, you're still going to get those choppy setups. You're still going to get setups that really don't confirm, but I want to give you maybe potentially a tip that can kind of help you stay patient a little bit more and try to stay on the right side of the trend. So if we notice here, when the market opens, okay, market's going to open here on this red candle. Okay, so this red candle that shoots down or immediately shoots up and then shoots down, vice versa, whatever, it's very, very choppy. But one thing that I want to kind of tell you guys is that if you kind of sit out, the first 5 minutes of the market and you let things start to develop, okay, meaning that you don't jump in just because the market shoots up off the bell or shoots down off the bell, but you kind of wait at least 5 minutes and you see some type of price action, it's going to help you get less chopped up off the open. 2, I want you guys to look at where is your 200 period moving average. Is it flat? Is it rising or is it declining? In this particular situation off the open, we can see that the 200 period moving average is flat to rising, okay? So if the 200 period moving average is flat to rising, this is automatically going to tell us maybe potentially we want to stay a little bit more long-sided bias until we close below the 200 period moving average, which is going to result in ignoring red candles, ignoring red candles, ignoring red setups, ignoring red setups, ignoring red candles, ignoring red setups, ignoring red candles, ignoring red setups. Although this was a good one, but again, for the sake of the video, we're ignoring those red setups. So what essentially we're looking for here is we're going to treat this as a scalping strategy, and we're going to look for what is the range of the reason why candle. Now, your reason why candle is the candle that closes over or under the 20 period moving average. Okay, so in this particular situation at 6:34 off the open, this is 4 minutes off the bell, we're going to get that reason why candle closing over the 20 SMA. Okay, now we've got a rising, we've got a rising flat 200, so we want to stay a little bit long, okay, long-sided bias. And what we're going to do here is once we confirm, right, once we confirm the high of that reason why candle, we're going to jump in that trade and we're going to treat it as a scalp. We're going to get in, we're going to get green, and we're going to get out. Okay, now your take profit is going to be set at half of the reason why range. So if this range of this reason why candle is 26 points, then maybe we're looking for 12 to 14 points, okay? 12 to 14 points take profit. Now, the high of this reason why is sitting at 18,081. The next 2-minute candle goes to 18,096. So from 81 to 96 is 15 points. This is a 15-point scalp that would have resulted in a W, right, which is a win, which would have resulted in that win in just 2 minutes. Now, depending on the level of experience and the number of contracts that you're trading, some people can trade 15 points, take profit, and be done for the day. How good would you feel if you can find a setup that lasts 2 to 4 minutes, take 10 to 15 points, and kind of call it a day, right? So if you just kind of do the math, if you were trading 1 mini contract, 10 points, is going to result in around a $200 winner. So if we're looking at taking 15 points, 14 points, 12 points, we're talking about a potential $200 to $300 winner, right? Let's call it 250. Let's just split the hairs right down in the middle. So a potential $250 winner in a matter of a couple of minutes is not a bad way to make side income. It's not a bad way to build an account. It's not a bad way to kind of pass these prop firm evaluations and get some additional monthly payouts. Now, whether you do trade for the prop firms or you trade a personal account, $200 a day times 20 some odd trading days in the month results in very, very good money. We're talking anywhere between $3,000 and $4,000, $3,000 and $5,000, depending on some better days, depending on some losing days. Now, again, you're not always going to end up with the green day. You're not always going to win every single trade. You will have those losers in there. Now, if we're ignoring the red setups, we're ignoring the red candles because our 200 period moving average is rising, then what we're looking for is the next potential play that sets up to the long side over the 20 SMA. Now, if you notice this particular setup here, okay, this particular setup happens for me at 7:20 in the morning Pacific Standard Time. The high price is 18,100. The range of this candle is 17 points. If we cut that in half, we're looking for 8 to 9 points to the upside. In a matter of 4 minutes, we go from a price of 18,100 to a price of 18,106. In this particular situation, this is where a lot of traders can tend to get chopped up, okay? So it shoots up with inside of 4 minutes, right? 4 minutes shoots up. You're looking for around, if the range is 17 points, you're looking for around, let's call it 8 to 10 points, okay? We're going to cut that in half. We're looking for 7 to 10 points, 8 to 10 points, 9 points, but we only get 6.5 points. Now this starts to pull back and you start to go red. This is where a lot of traders can tend to get themselves in a lot of trouble, especially when we go into a choppier environment. Now, your stop loss is going to be a 17-point stop loss, okay? So your stop loss is going to be a 17-point stop loss. We're going to use the reason why candles low wick. If we do get below that, we're going to want to get out of that trade. You can see that although we pull back, we never take out that reason why low, resulting in the next pop that goes to a price, okay, of 18,109 and then 18,111. So if we're looking for, okay, if we're looking for around 7 to 10 points, you would have got it once this next little spike starts to go higher. Now, again, if you're one to think about, well, if I'm going to risk 16 points and I'm only going to take 8 points, wouldn't that risk to reward ratio be a little offsetting? Because if I do take a loss, I'm going to need at least 2 trades to get me back into the green versus just taking a potential 1 trade. The answer is yes. However, with a scalping strategy and system like this, what we are banking on is having a higher win rate, okay? So when we have a higher win rate, it's going to allow less emotions and allow us to stop trading on the day and make sure we secure those profits. Now, again, you're going to take those losing trades. Sometimes you're going to give back a trade. Sometimes you're going to give back 2 trades. But understand that over a course of 20, 40, 60, 80, 100 trades, with a higher win rate percentage, you're going to lock in more green days than you are red days. Now, if we look at the next potential setup at 7:36 in the morning Pacific Standard Time, the range here was 10 points. What we would be looking for on this particular situation is 5 points. We're going to take the range, we're going to cut the range in half, and we're looking for 5 points. The high price was 18,101. And we go up to a price of 18,111. So you would have taken another additional 5 points here. We're looking at 8 points on this setup, right? That ends up pulling back and cashes out here, or we're looking at 5 points here, and we're looking at that original 12 to 15 points on that first trade. So at this given time, with about an hour into the market, we should be up anywhere between 12 and 20 points on the day. Now, if you're trading, let's say 5 micro contracts and you take out 20 points out of the market, you're looking at essentially making $40 a contract times the 5 contracts. You're looking at around $200 in profits. Again, let's say you're trading a little bit lesser size, you should still be up around $100 to $150 on the day. Now, again, I know this is not life-changing money, but we're not trying to make $1 million in one day. We're not trying to make $10,000 in one trade. Although that sounds great, that sounds nice, I believe in much more of a slower approach to the market, a much more calm and sensible approach to the market, something that's replicatable, right? Something that's duplicatable, however you want to mark it up, something that you can come into the market and do on a day in and day out basis. Now, again, by using the 2-minute time frames, you are going to get a little bit more choppiness action when the market is ranging. You can get those stop outs rather quickly, but your range on the amount of risk that you're putting on the table as far as points is going to be a lot less than, say, using the 5-minute time frame, 15-minute time frame, 1-hour time frame. Again, the larger the time frame, the larger the range, which means the longer you need to sit in trades and the more stop loss you need to give yourself. We can never pinpoint exactly where potential stop loss is going to be. We have to just manage our risk accordingly based on the technicals that's going on the chart. So again, just keep it very, very simple. Now, you're going to see a little bit of a play that got stopped out here. This play does confirm at 8:08 in the morning. Quickly puts in a little bit of a range here and then gets stopped out. You can see another trade that sets up, however, never confirms. And then you can see another trade going into later in the day, right? Coming out of the middle of this lunch hour, almost at the end of the New York lunch hour, we get this trade that does confirm and would have paid off as a winner to the long side there. Again, in that trade would have resulted in around 7 points. And we have another trade here that would have resulted in around 4 to 5 points here long on this particular situation. And then you get that last end of day setup to the long side here that would have resulted in another 5 points. So if we're looking to take between 5 and 10 points per scalp on a 2-minute time frame, you can run through and get maybe 4, 5, 6 setups a day. Yes, of course, you're going to lose some, but if you manage to manage your money accordingly, meaning that if you go up $100, $200, $300 very, very quickly, you got to stop trading on a day, guys. I can't emphasize it enough that the more you trade, the more likelihood you are of losing the gains, okay? The game of probabilities just means nothing more than a game of numbers. So the more trades you take, the longer you're sitting in the market, the more you're giving the market an opportunity to take their money back. You have to look at it as if you go to the roulette table and you throw $500 down on black and you win $500 on black, doubling your money. What are the odds that you're going to do that another 2, 3, 4, 5 times in a row? The odds start to go down and down and down. Again, I'm not calling trading a game of luck, but there is a percentages. There's probabilities that are built into this system. We're not always going to win. Now, you can get to a day where you take 2 or 3, 4 trades and you win at 100% win rate today, and then you can have the next day where you win at 50% or 40%. It's just the name of the game. But the reason how you're going to stay in business and stay in business for the long haul is by managing those profits. Again, if you do manage to take 2 losses and you're down $200, $300, if you're trading for a prop firm and you have a $50,000 account, I would recommend setting a personal daily loss limit of around $300. If you lose more than $300 on a day, you need to stop trading. Again, the more you trade, the more you're going to give back, the more you're going to have FOMO and start to revenge trade. Again, the same thing for your profits. If you manage to make $200 or $300, you got to stop, right? It's just what it is. If you guys want to try out the 2-minute time frame, see if it works for you, for yourself. Again, set it up. Use a 200 period moving average. If we're trading over the 200 period moving average, we're going to ignore the short positions. We're only going to look for the long positions. And then we're going to find those reasons why to take those trades based on the 20 period moving average. So the 200 is going to decipher whether we're going long or short, looking for long or short trades. And the 20 SMA is going to determine when we're going to actually get into these trades. Again, these trades should pan out within 2 to 6 minutes. I like to see them happen within the first 1 to 3 minutes. But again, not every trade is going to be perfect. I hope you guys enjoyed this video. Maybe opens your eyes to a different way of trading or maybe a little bit of a different style of risk management. Again, you have to play with the numbers and see what works for you. Just because something works for me doesn't mean it's essentially going to work for you. There's a million ways to make money in the market. You got to find the one that fits your personality and trading style. With that being said, like, comment, subscribe. I'll see the rest of you guys on the inside.